You must be logged into my account. Hey, Brian, I don't know if you're on yet, but I think you're muted.
Hey, Sean.
Hey, how you doing?
Good. Can you hear me okay?
Yeah. Let me, one of my headphones is on. Let me just switch this out. Hold on a second. All right. I think I'm back on. Is this working?
Okay. Yeah. So, excuse me.
All right. Are you going to need to do a screen share?
No.
Okay.
Who's the audience?
We have 33 meetup groups that we organized. So there's going to be a variety of kind of experience levels, interest in there. So we will get everyone from people who are brand new to people who've been, doing stuff on bigger pockets. Everyone's will get some pretty experienced investors. We'll get some, professionals from other fields who are looking to invest.
Okay.
Yeah.
Yeah. No, I I don't have a presentation. I can put up some stuff if you want, or we can just.
No, I
keep it
I
like
was
this.
asking because I think if you do a screen share, I have to enable that on my end.
Okay.
Yep.
No.
And where are you located? Are you in Tennessee, or am I thinking of somebody else?
No, you're right. I'm in Nashville, Tennessee.
Oh, great.
How about you all?
We're in Orlando, Florida.
So nice. We're doing a deal there. We're under contract to buy a retail property in College Park.
College Park. Yep, that's just a few minutes from here.
Yeah, that's where I live.
Yeah. Oh, nice. Yeah, we're pretty excited about it.
Yeah, my parents used to live in Nashville. They moved there when I was 17, so I used to go there a lot. And high
Nice.
school and college. I think they lived there about 10 or 15 years. I never really lived there, but I would spend time during the summer and like Christmas there.
Sure. Do I have your mailing addresses?
I don't know. I can send it to you on the.
I'll send you an email. I'd like to send you all a token of thanks for having me on.
Sure. Does your company primarily do retail properties, or what's the focus?
Yeah, we actually don't have a real product focus in terms of asset type. It's more about providing a solution set to our investor base.
Mm-hmm.
So we do three things. We give them access to direct deals, double-digit cash-on-cash yield, and then all the tax benefits that come along with direct real estate ownership.
Mm-hmm.
What that looks like is typically flex, industrial, medical.
Mm-hmm.
But we'll do office, we'll do retail. We're opportunistic.
And you guys, sounds like you cover different markets too, right?
Yeah, we're in 14 markets total.
Mm-hmm.
Mostly Midwest, Southeast, mostly kind of secondary, tertiary markets.
Mm-hmm.
How long have you guys been doing this?
Ooh, I started as a broker in '95, did residential in Orlando for about a year and a half, and then I started doing land brokerage for a group of investors, suburban, kind of around the exterior along, where expressways were planned to go through, and looking at, growth corridors, and, they just be like, drive out here, find land, did that.
Right.
And then once it came time to develop it, by that time I'd like work with them long enough, like, hey, now we want you to start developing, taking this stuff through entitlements. And so I got into that after about 4 or 5 years, and did primarily just single family subdivisions. Every once in a while we'd like kick out an apartment site, but we would sell finished lots to production home builders like Lennar, KB, Pulte, did all that stuff. We probably did about pipeline of about 6,000 or 7,000 lots, and like those first probably 2000 to 2006. And then 2006 we started getting like really bad signals, so we started to exit some of our land things. Almost all of them we had large option deposits from builders, so we definitely lost money on like 2 or 3, but most we were able to exit or restructure it with the guy. And then got into distressed multifamily in 2008, 2009, 2010, which was totally different switch, because then it was income producing properties. Actually turned out to be much easier than land development. Sometimes you're doing a job, you don't realize, how complicated it is. I'm like, this is way easier, way faster. Not as exciting, I would say, but I learned the whole income side, and then worked with Class A developer on building new projects, kind of like 2011, 12, 13. And then we started doing value add rehab on multifamily, built up a property management group that manages about close to 500 units now, and started doing land development again when that market started coming back. It's probably like 2 years late to when that really started, but so we're doing those projects now, and we're also building single family homes for rentals or for sales, because that's a huge demand down here too. And
Sure.
so it's a new, kind of came out from being familiar with the rehabbing apartments. I'm like, well, building a home is kind of like rehabbing everything, so there's a ton of money down here. I know you guys have the same thing in Nashville. I can't think of the guy's name, but there's a gentleman up there connected with on LinkedIn who's been doing build to rent subdivisions up there for a while.
Who is it?
I think his name is Bruce. Shoot, I cannot think of his last name, but starts with an M. I can find him on LinkedIn. I'm connected to him, but we just have a ton of kind of private wealth, high net worth investors, hedge funds, investment groups coming down here, and like, I need to buy 50 homes. I need to buy 150 homes, 200 homes, and they just want to do the whole thing as a rental portfolio.
Yeah, seems like there's a huge amount of appetite for that right now.
Mm-hmm. Yeah, so we're doing one of those. It's a 200 unit. The whole thing is going to be designed from the get-go to be rental property. One parcel. It won't even be platted into separate lots. So it's definitely the way the market is going down here. Hey guys, I've started to admit people into the room. This is Sean Myers with Brightleaf Properties. I think you come in on mute, but if you want, what we usually do is have people type something in the chat room, where they are, what their name is, what city they are operating out of, or markets interested in, and what kind of stuff they do. Devin James is also on. He's works with me here in Orlando, Brightleaf. So just kind of informal chatting as we wait for people to get in. Give everyone a little time to get in here, and then Brian Adams is going to be our speaker tonight, talking about market selection.
I can introduce myself here if you don't mind, if we have a moment.
Sure.
Okay, I am Nicole Shepard, and I am starting a wholesaling company in Fort Myers. We're going to be doing some virtual wholesaling. Today is really kind of about making connections and just gaining any kind of information that will be critical for us to get our feet wet, start down there.
Okay. You said you're in Fort Myers?
Uh-huh, yep.
Great.
Absolutely.
Are we going around with just doing introductions at this point, or sorry, Michael?
Hey, Michael. Yeah, while we wait for people to log on, you can kind of type in an intro for yourself in the chat if you want, or you can just kind of unmute yourself and do an introduction. The chat file is something that people can download at the end of the call. So if you want to get those contact information, it's right in there.
Thanks.
I see you're in Franklin, Tennessee, so you're close to our speaker tonight. He's up in Nashville. Another person in Nashville, so Tennessee people.
Hey Nicole, what type of properties were you looking to wholesale?
I'm looking to wholesale single-family homes, what we're going to begin with. Yeah. Let's see.
Yeah, how many? We've got 15 people logged in right now. Usually give people about 5 minutes to get in. Excuse me. Hi, everyone. My name is Sean Myers. I'm with Brightleaf Properties, and my associate Devin and I are hosting this meetup tonight. And I want to welcome you all in here. We do this as kind of a way to network with people in our market and across the country. Never know where opportunities are going to come from. And we try to provide some educational content every week. Our speaker tonight is Brian C. Adams. He's going to talk about targeting secondary markets, and sure give you some good information on how to pick. Sometimes you get lucky enough to be in a great market. Other times it's sometimes better off to find market offers better potential than what's in your home site. Brian, I'll go ahead and let you introduce yourself. You want to get started. It's pretty informal here. So he's going to do his presentation, and typically we'll do a question answer, and it's up to him if he wants to take questions during his thing or just kind of save them for later. And again, you can enter into the chat if you have questions. We can come back and follow up on them, or go ahead and feel free to introduce yourself in the chat also. And I'll just hand it over to Brian.
Thanks, Sean. I appreciate you guys having me. Listen, based on what I'm seeing on the chat, I'm happy to go into the market selection. But it seems like most folks want to get into this business as a sponsor and GP. So if it's helpful at all, I can also talk about how to raise capital as a first-time sponsor entrepreneur. I do have a presentation along those lines. So I think I can probably hit both, but we can kind of go with it, Sean, whatever you want to do. I just want to be the most helpful I can to the audience.
Mm-hmm.
So why don't I go through my story? We can talk a little bit about market. And if you all want, we can talk about raising money. So Brian Adams, I'm a New Yorker. I married a Nashville native. My wife and I met in college in Connecticut. Moved to Nashville about 15 years ago. Was very fortunate on many levels. One of them is that my wife's family has a single family office that had invested in commercial real estate pretty heavily over the last 25, 35 years. So I practiced law, and then I got exposure to the world of private equity, commercial real estate through the family investments. And that was kind of the end of it for me. I became enamored with real estate as an asset class, as a business, as an industry. Started the company 11 years ago. Initially started raising funds, kind of blind pool, commingled fund vehicles. Ended up doing decently. It was hard to raise money that way, frankly, but ended up eventually offering our fund investors direct co-investment sidecar opportunities, deal by deal. And that's really when the business took off pretty dramatically. The fund LPs, the fund investors loved that approach. And they started bringing their friends and family, and we really hit our stride from a fundraising perspective. So we built up about a $250 million portfolio of mostly suburban office over the course of 3 years. So it's pretty dramatic growth. Looking back on it, we definitely grew too quickly. We made a ton of mistakes, and we can go into those if there's interest. And eventually fixed those mistakes, and pivoted towards doing just deal by deal syndication. So 2.5 years ago, I started Excelsior Capital, which is my current company. And we can get into specifics, but really simplified the pitch to just give people direct deals, double-digit cash-on-cash yield, annualized, that we make monthly distributions on. And then we only work with accredited but non-institutional investors. So we do everything we can to accentuate the benefits that come from direct real estate ownership, mostly through cost segregation analysis and accelerated depreciation. So that's kind of the story. Today, we have about 16 employees, about $410 million of gross asset value, real estate across 14 markets, mostly in the Southeast and the Midwest. So with that, the conversation today is going to be about market selection. And I can tell you that we started our own backyard. I think like a lot of people do, they invest where they feel comfortable, what they know. And that makes a lot of sense. But kind of as Sean mentioned, you know, I've been doing this for a while. He's been doing this for a long time. Markets come and go, right? Markets become sexy, then they become unattractive. And in my opinion, you need to have an investment thesis kind of overlaying your strategy. And you'll hear this adage in real estate that demographics are destiny. And it's largely true. No matter what food group or asset type that you're focused on, you really need warm bodies to be there in order for buildings to stay full and valuations to increase and to get that type of momentum in the market you want. And so for us, the reason we started looking at secondary markets, to be honest with you, is because that's where we could find value. We couldn't be competitive in large MSAs because we're so cap rate driven. And we ended up, having to leave Nashville. Then we went to Raleigh. We had to leave Raleigh. We went to Tampa. Then we had to leave Tampa. And so every 2 or 3 years, we've had to cycle out of different markets because our cost of capital, or what our investors expect, is too high to afford to transact in some of those marketplaces. And so for us, when we think about, new markets to go to, the overarching story that we talk about is this demographic shift within the millennial generation. And so it's really important, I think, when you do your pitch, to have this kind of macro thesis overlay on top of it before you get into the specifics of the deal. So I can give you mine just to give you a sense of what that looks like for us. And so the way we typically frame it up is, for a long time, the narrative on Wall Street was this maturing millennial generation, which I'm a member of, roughly 75 million people total, the largest working generational cohort in American history. Many people thought that this group was going to never get married, never have children, going to live in Brooklyn and wear skinny jeans and eat avocado toast, and that was going to be the end of it forever. The reality was, because of the Great Recession, that family formation phase got pushed back 3 to 5 years on average. But once people started getting married and having children, they needed to make decisions about where they wanted to live, work, and play based on cost of living, quality of life, access to single family homes, and access to education for their children. And when you take all that into account, secondary markets or non-gateway cities in the Southeast and the Midwest check all the boxes and become very attractive. So we started seeing this play out on the employee side. Anecdotally, we would have friends leaving New York, Boston, or LA, and they'd be looking to relocate to a place like Nashville because they were getting killed with taxes, and they had 1.5 children. And that was the start of it. I think what you saw really pre-COVID was the employers realized, access, obtaining and retaining human capital talent became one of the biggest challenges for business owners. And so having a physical footprint and planting a flag in these markets that were growing, that had access to that human capital they needed, became paramount for them. And so we started seeing that play out on the employer side. You had Alliance Bernstein moving to Nashville. Others, obviously some big names. We all know the story about Austin, Texas, and Florida. And it's cliche, but true, that COVID accelerated a lot of trends that were already in place, right? So you had financial services firms who had been getting crushed in the city. I think it was really, politically expedient for them and a smokescreen in a lot of ways for them to make moves that they had wanted to be making for a long time. And COVID allowed them to do that. And so you've seen this kind of financial services growth in places like Miami, et cetera. So that's how we think about kind of the macro trend of choosing a market, right? You want year-over-year population growth, wage growth, job growth, et cetera. And you want underlying economics trends that are, resilient, right? So for us, we usually pitch the eds and meds story: so education, healthcare, government, STEM industries, things that are resilient and anti-cyclical to some of the recessionary cycles that we've seen play out over the last 10 or 20 years. So once you've kind of got that macro story that you believe in, then you go to those underlying MSAs, those cities that have the characteristics that you like. And then you go down to the submarket level, right? So for us, submarkets are neighborhoods within these MSAs. We like to see submarkets that never experienced more than a 10 or 12% vacancy rate during the Great Recession. I think in a year or two, COVID will allow us another stress test that we can use, but that's the most recent one. And relatively mature submarkets. So places that have been around since the 70s or the 80s, but that still have a good quality product that is not too expensive. So we look at things on not only a cap rate basis and not only a replacement cost basis, but we like to use this concept of relative to replacement rents. And what I mean by that is in the commercial space, if the nicest Class A office building in, Winter Park in Orlando is renting out at $35 a square foot, but the cost to build a new product type in that submarket, that it would require rents that would be in the $45 to $50 a square foot range to justify new construction or spec development, feel very protected there as a landlord, right? So it's more of a defensive posture. But those are all the metrics that we track. So once we screen through all of that, you probably end up with 2 submarkets per MSA that you could enter into that kind of meet your screening for underwriting purposes. And then you go into, what price point do you want to play in, et cetera. And then you try to expand from there. So I know that was a lot, but that's how we think about kind of large macro thesis, investment strategy, what MSAs screen for us, and then within those MSA cities, what submarkets that we would like to participate in as an investor. I don't know if that's helpful or not. I think you're on mute, Sean.
Hello, my name is William. You mentioned that you was from New York, and you mentioned you visited a few, you relocated to a few different places, and you said Raleigh, you came to Raleigh and you left. See, I'm from New York also, but now I'm in North Carolina looking for investment opportunities. And I'm just curious why you left Raleigh, because I'm like 20 minutes from Raleigh. I know it's very expensive in Raleigh, but you got sub markets right around Raleigh that's with potential. But what was your reason in that? Why didn't you find this a worthwhile market? Or maybe
I think it's a terrific market, right? But there's a difference between markets that are great places to live in and great places to invest. So for us, we did 2 transactions in Raleigh. They're both in Cary. They've both done very well, but we have to stay disciplined our investment thesis and underwriting. And at a certain point, Raleigh became an institutional marketplace. And in my opinion, cap rates where they are for the type of products that we buy don't justify investment today.
Okay, thank you.
And what kind of cap rates are you guys targeting? And are you doing a kind of repositioning of the assets, or is it something we're just targeting those markets where your entry cap rate is delivering your kind of upfront returns?
Yeah, so this is a concept that I didn't fully appreciate when I first got into the business. And it's a term that gets thrown around a lot. Cost of capital, right? For me, my cost of capital, what my equity investors want in return for the risk and illiquidity they take on by participating in one of our offerings, is a double-digit cash-on-cash yield day one. And so for us, without taking on too much risk or leverage, I need to be in that 7 to 8% cap rate range going in. Now, we can certainly do some value add components, and it's not going to be consistent every year, but we really need to be there. Even with debt as cheap as it is, to make the numbers work. And so that means places like Raleigh, which are terrific, for my product type, kind of flex, medical or industrial or office, they're probably going to be sub 7%. So I can't afford to buy there.
Mm-hmm. And what's your typical deal size that you're looking at?
If I had pitched you 3-4 years ago, I would have said 15 to 25 million
Mhm.
acquisition cost. Today, just given how much liquidity is in the market and where cap rates have gone and how competitive it is, we're now usually sub $10 million.
Mhm. And that's another function
So
of changing markets too, is you sometimes have to change strategy and I don't know if everyone on this call, but when Brian's talking about institutional investors, he's usually talking about large groups that have a very low return target, meaning they'll pay a lot more than someone like Brian
Yeah.
would pay.
Right,
they're
and
not
that
trying
goes
to get the
and that goes back
return.
to the cost of capital concept, right? And it's hard for people to understand. But if you're a German insurance company and you're getting a negative 1% return on your bond portfolio in Germany, doing a 3% deal, like buying something for cash at a 3 cap in America, that's a pretty good return for them. Now, their cost of capital is really low. You know, for most individuals, they're going to want a much higher return, but that's why you see these crazy cap rates going on, because for international investors or domestic investors that have a very, very low cost of capital and a long enough time horizon, those deals can make sense. They don't make sense for me.
Now, Brian, you mentioned that you invest in office and flex spaces, industrial. What are you seeing as far as shifts in the market from a demand perspective in office? I mean, I think we can all kind of somewhat agree, and maybe I'm completely wrong, but when COVID hit, a lot of us, we rent office space and we see kind of the dynamic of what's happening in the real estate market, at least here locally in Central Florida. And a lot of us kind of assume like, man, it's the office world over. I personally was kind of on that boat of saying like, well, how are you going to get people back to the office? I've kind of changed my mentality a bit. And I think after people being cooped up for about a year, they're kind of getting back into saying like, man, I think I want to be back around people and I want to be back in an office environment. I mean, are you seeing kind of that change of folks kind of saying like, okay, well, that was great for a year, but there is real value in being in an office environment?
Yeah, so it's a great question. We get it a lot. We run about 2 million square feet of suburban office across multiple markets. So I can tell you that when COVID first started and lockdowns started, being executed in earnest, the death of office was a narrative that you heard a lot, right? That everyone's going to work from home forever, and it was great. I think we can all agree that spike in productivity was really due to the novelty of working from home for a lot of people, and also the fear of losing their job. But after about 6 months, the kind of the rose fell off the bloom, and productivity went down, creativity went down, depression and isolation went up for a lot of employees. And for a lot of folks that have roommates or live in a small apartment building, really not a very comfortable existence for them. And so as COVID kind of waned and things got better, you saw kind of a return to the office. And now, we were experiencing really good momentum from a leasing perspective heading into the summer. But with the Delta variant, that's definitely taken a step back. And so I think employers are like most people. They don't know what to do, right? They can be a bit schizophrenic. They're not sure if they should have all the employees back in the office, if they should go back to work from home, if they should have a hybrid setup. Leasing momentum and lease renewals have been muted for sure within our portfolio. And we're pretty much at around 80 to 85% occupied. Same on renewals and lease collections, sorry. I think long-term, and I'm biased, right? I do have a dog in this fight, but I think we are social animals, that we do have to have some group meetings or group setting in order to be productive employees. And you've really got to separate, when you read the articles and you see these things, it's not really what employees want. right? Like those numbers and those polls and those surveys, they're not worth a whole lot in my opinion, because employers are the ones with the power
Mhm.
for the most part. And employers want people back in the office for the most part, some of the time. Because otherwise, the invasion of privacy for people working from home will be so much that I think employees will chafe at that. And also, you've got to realize, and you're starting to see this in the newspapers, you're just not going to get paid the same if you're living in Idaho Falls, Idaho, full time and working for Google, as opposed to being in San Francisco and come to the office every day. Like, you're just not going to get paid the same. So, you know, I think we'll see this continue to be pretty bumpy for the next 12 or 24 months. But I don't think this is a secular shift like we saw with retail, for instance. I just think it's going to be a change, right? Where, you know, pre-COVID, we saw this massive densification of a WeWork effect, where we had close to 75 square feet per user in some of these locations. A traditional office layout of 350 square feet per user. I think it'll be somewhere in the middle, right? Where people will be in the office a couple of days a week, and it'll mostly be for kind of group sessions where you can be creative and come up with new ideas and work through bigger issues. But employers are going to have to be more flexible in order to get the best talent. And that will mean allowing them to work from home or work different hours. I think you'll just see more of a workforce that's distributed across multiple markets, as opposed to everyone having to be in New York or Chicago or San Francisco. I think there'll be multiple offices around to accommodate the employee base.
That's fair enough. Now, the other question that I had is that, as far as your perception of, or kind of what you shared as far as your shift every 3 years, I think is what you mentioned, in an effort to, I hate using the word chasing cap rates, but trying to find the more suitable markets that fit within your investment criteria. You know, the obvious is that some of these companies and some of these cap rates kind of start moving with taxes are important, right? So we're here in Central Florida, we're here in Florida, and we mostly focus on residential. So that's the thing that I can speak with some type of certainty. And we do see an influx of folks coming from all over the country, and especially the Northeast. We're seeing a lot of folks coming from California. Maybe California is kind of heading more towards Texas, that is a little closer for them. But we're seeing folks coming to our state based on the political environment that's happening, and folks feel a little more comfortable where the state is going and everything else. I mean, does that have any kind of impact on your investment strategy, on how you kind of look at the investments and you look at the political scene that's happening in that particular state or in that particular submarket, from not just from a state level but more from a localized kind of city, municipality, et cetera, I guess?
Yeah, 100%, right? I mean, when you see the census data showing that California and New York have lost congressional seats for the first time in history, as opposed to gain them, that's meaningful. That's a real shift in demographics. And unfortunately, these markets in the Northeast, on the West Coast and Chicago, are in a very difficult situation where they are going to have to raise taxes and cut services in order to prevent bankruptcy. And when you do that, you create a fairly vicious cycle where more affluent people leave along with their businesses to avoid paying those taxes and not have that negative experience of living there. I do think at a certain point, places like New York become affordable again and encourage entrepreneurship and younger people to move there, because honestly, a lot of these markets were becoming unaffordable for many, many people. And so hopefully that will kind of reset. But again, you have to remember, you know, I'm not that old, but New York in the 80s was a hellhole. Like it was a terrible
Yep.
place. And then they cleaned it up. It got cool. It had a good 25-year run. I mean, these things go through cycles, right? I mean, who would have heard of Nashville, Tennessee 25 years ago? Now we're the #1 bachelorette destination in America, beyond Vegas. I mean, we have Oracle here. We have Amazon here. I mean, these things do go through cycles. But I think your point is well taken that it's not just about the state level politics, but within the state, local politics does make a difference, right? I mean, if you were looking at Tennessee, would you deploy capital to Nashville, Knoxville, or Memphis? I mean, the local politics do make a big difference. And if you could continue to put money to work in Florida, Texas, and Tennessee, I think over the next 10 years, it makes a lot of sense.
Hey, Brian, I was going to say, I don't know if anyone, like I said, if you have questions, feel free to unmute yourself or type it in. But yeah, I'm looking over the people who log in. Looks like we have a lot of people who are kind of just starting investment journey. And you mentioned before, being willing to share some of your mistakes, lessons learned. I think that's a great thing sometimes to tell people. Fastest way to learn it for me is to do stuff, and you're always going to make mistakes. But as long as you learn the lesson from them, it's good. And especially if you can learn from somebody else's mistakes before you commit it yourself. So if you had a couple things like that you want to share, it'd be great.
Yeah, so I definitely encourage people to click on the link I put. There's no cost or anything. I get the number one question I get is, how do I raise capital from first-time entrepreneurs and sponsors? And that's really what I do all day, every day. And so that presentation's got a lot of really good stuff in there. It's not just big thematic. It's really kind of brass tacks, granular. Like the first time you're doing a deal, this is what you should do over the course of 100 days. So hopefully that's helpful. And I can get into that if you want, but mistake-wise, we don't have enough time to cover all my mistakes. So I'll just highlight some of the big ones. Biggest mistake, and this goes towards capital raising, coming out of the box as an entrepreneur with an idea that you think is really cool and compelling, but that nobody else does. And what I mean by that is, if you don't have a good sense of what your investor base looks like and what they want, and if your pitch is ego-driven about what you think is cool and how smart you are, and then you try to cram that deal down your friends and family's throats, it'll work to some extent, but it'll be really hard. And this business is all about how to scale efficiently, and it's a capital-intensive business. And so the reality you have to face is, given the capital-intensive nature of this business, you need to be the chief sales officer and the chief marketing officer. And you need to have a product that's a solution set to your investor base and not what you think is cool. Because something that's cool and interesting, it has worth. It's called art, right? But art is not a business necessarily. You need to be able to scale and repeat your fundraising in order to have a real estate business. Now, that being said, another big mistake I made was getting caught into a trap that a lot of people do in this real estate world of being a deal guy, right? Being very focused on acquisitions, going out and cowboying it, just finding opportunity. I definitely fell into that trap. And the problem is, unless you have the infrastructure set up around your company, sales, marketing, investor relations, tax, audit, HR, accounting, bookkeeping, asset management, reporting, everything, it really doesn't matter how great the deals are. If the investor experience is really poor, it's going to be really hard for you. And so you've got to be comfortable with the concept that if you just want to be a deal person, stay being a broker. If you really want to be a sponsor and a GP, you need to have a small business owner mindset. And that means putting resources and time to work on things that don't really have anything to do with the deals themselves. Those are the two big ones that I can think of.
Brian, I really like the second one you share, because we've had a similar experience actually very recently. And And as you mentioned, it doesn't matter how good the deal is and how good the deal is going. And I can tell you, I mean, very, very personally, there's a deal, I work with Sean and Devin who are on the call. There's a deal that we're currently working on, and it is a killer deal. I mean, it is just pumping out the cash that it needs to pump out. The equity that it's creating is buying additional assets. I mean, it's really killer. But where we failed is that investor relation of saying like, hey, listen, this is what's happening along the way. You trusted us to give us the money. Your money is safe, but of course you want to know what's going on. And it is important to keep people in the loop, and the investor relations cycle is paramount to making it happen. So, you know, we've had great conversations recently and things are great, but we've learned as a company that, you know, in previous experiences, we've been very good at communicating with the investors, but in particular deals, you have to spend a little bit of extra time doing and enhancing that investor experience. Because after all, I mean, you don't do a deal with an investor, you don't bring an investor on board for a single deal, right? So the thought is, let's do this deal together and then kind of go to the next steps and do more, I guess.
Yeah, I mean, if you're not providing ultimate transparency and over-the-top reporting, no matter if the checks are coming in or not, people will be suspicious and their minds will go to the darkest possible place, right? I mean, that's just human nature. And I can tell you that you will spend more time and effort managing those relationships than it would have taken just paying to have a really good investor relations portal, platform, person, you know, doing all the communication for you. It sucks. Like it's not a revenue generating business, but you cannot scale efficiently unless you have it.
Mm-hmm.
So that's been my experience. Let's see, people like to talk about my mistakes. Oh, go ahead.
I was going to make a comment when you were talking about that, since you're talking about capital raising. And as Brian mentioned, he did share a link to that. And we've been doing these meetups a little over 2 years now. And one thing I see a lot with people who are just getting into investments is the mindset that they're doing it all on their own. So that some people tell me, you know, I haven't bought anything yet, or I'm waiting to save up a down payment to pay my second property, or I don't have the ability to borrow money. So I think if you really want to be successful in real estate, you need to spend a good amount of time understanding how to raise capital, even if it's just a friends and family thing, because there's people with money and they're looking for opportunities. And if you've spent the time to educate yourself on real estate and understand the market you're working in and the product, there's typically other people who want to invest with you. And so you need to learn how, and it's something you have to do. You have to put in the time, but that's the biggest thing I see holding back people who are new, is not thinking of what they can do with other people's money by providing opportunity for them. Just, you know, they're kind of stuck waiting to do everything themselves. So, you know, I would encourage you to spend time learning how that works, in addition to learning, you know, whatever your real estate market and niche is going to be. And like I said, he's got that link in there, which is, I haven't seen it, but I'm sure it's going to be something helpful to you as you start on that journey.
Yeah, and I think it's also important to realize as you get into this business, don't fall into the trap of comparing yourself to others in terms of square footage, AUM, capital raised, employees. I think that's a huge trap. Not only is comparison the thief of joy, you really need to be focused on your GP business. Like whether your general partnership holding company business makes any sense. I know a lot of people who are desperate to get institutional private equity to come into their deals or their funds, and they really lose sight of the fact that the economics and the fees and the controls are terrible on those things. And at the end of the day, who cares if you have Blackstone in one of your deals? If it means that you're making, you know, a lot less money than you would otherwise be. So you've really got to think through what kind of business you want to be in, because there's always going to be somebody bigger, right? But that doesn't tell the whole story. You see a lot of stuff on LinkedIn and elsewhere about people taking down these big deals or how much they've raised this year, but you don't know the details behind those stories. And I can tell you the most successful GP sponsors I know, they don't focus on square footage or AUM.
Hey, Brian, there's a
This,
couple questions in the chat. Alvin asked how much weather plays a factor in finding a market. And then Sal asked how to find people to invest with as a beginner.
So I'll take Sal's question first because it's easier to answer. The deals, you know, it's going to be simplistic, but you've got to have a broker relationship, right? You have to have two funnels. You have to have a deal funnel and then a capital funnel. And the deal funnel is a little bit easier to manage because brokers get paid when you get deals done. So I'd really focus on your brokerage relationships. I think this concept of off market is thrown around way too much. I mean, I've done a lot of transactions, principal to principal transactions, truly off market without an intermediary, I think are extremely rare and probably a bad idea. So it's going to be brokers as the lifeblood of your deal flow. I can tell you what we do is, you know, $10 million deals, investment sales brokers are not going to fool around with them. Leasing brokers usually have the relationship with the owner, the seller. And our pitch to them is, hey, we'll keep you on the leasing side of this, or we'll reward you the leasing work if you give us a 30-day exclusive with the owner. And, you know, that typically means that we get kind of off-market looks or inside lane looks. And once you build up that reputation and brand, you start doing some transactions, you'll start building, you know, good pipeline of deals, in my opinion. In terms of people to invest in, so the way to do this is before you find your deal, put a list of 100 people down and list them 1 to 100, starting at the most affluent, sophisticated people you know, going all the way down. This is not a judgment of how good they are as people. This is you just making a gut call on who you think can write the biggest check and who has the most experience doing private real estate deals. So you do the list, right? And there's an adage that a mentor told me once when I first got into the business: if you want advice, ask for money. And if you want money, ask for advice, right? So when you go to these people, you say, hey, I really just want to get your advice about something. Take them to coffee, do a phone call, do a Zoom meeting. You sit down and you ask them, okay, have you invested in real estate before? Yes. Okay. Well, what was the experience like? And at this point, you're just taking as many notes as you can. You're taking down all the details, what they liked about it, what they didn't like about it. And so ideally, you're getting the entire picture of exactly the return profile they want, the legal structure they want, how much they could reasonably allocate to the deal, what diligence items they would need, how they want to be pitched, when they want to be pitched, right? And you go all the way from 1 to 100. You take all those notes together and you say, hey, listen, you know, I'll be in touch. And we can do the marketing stuff later about how you can keep them warm. But if you do it thoroughly, you can probably do it in 30 days. And then you find the opportunity, right? And instead of you cramming it down and hard pitching them, doing ground and pound, you start at 100 and you work your way all the way up to 1. And you start with 100 and you say, hey, Bill, hey, Susan, I told you I'd be in touch. I found this opportunity that's a solution set to your problems. And it's packaged exactly how you want it. And the minimum is within your allocation limits. And I'm pitching you the way you want it to be pitched. Hopefully by the time you get to 50, you've gotten all like the weird pushbacks, the odd questions, and your pitch is much tighter, so that from 50 to 1, you might actually have a chance to convert some people. In my opinion and experience, your conversion rate's going to be about 1%, right? I've got 5,000 people in my distribution list. Typically 500 look at the deal, 50 participate. So you just need to be realistic with what you can do. But in terms of your first deal and how you should pitch it and how you should pre-market it, that's my opinion about how to do it. Not always what people want to hear, but the truth.
I mean, it involves work.
Well, what I see a lot is, a first-time sponsor will say, I've got a $20 million opportunistic multifamily deal in Odessa, Texas, and it pencils great. Like, that's awesome. Why are you calling me about it? Like, well, I need to raise money. I'm like, well, who do you know? Well, I've been in the Marines my whole life and I just got out. So I know a bunch of enlisted Marines. I'm like, well, do you think you can raise $20 million? No, not at all. Then why are you fooling around with this? And like, the people that would give you money, do they want an opportunistic multifamily deal in West Texas? No, I'm from Chicago. That's all the people I know. What are you doing? Like, I think the worst myth going today is that you'll raise on a good deal. That's a total joke, in my opinion. You need to take the sales and marketing seriously, otherwise you'll be spinning your wheels for a long time.
I think that's
And
all very
then,
good information. Go ahead.
Alvin, back to that question, just asking how much weather plays a factor in identifying potential markets.
Yeah. I mean, unfortunately, there's bad weather everywhere now. So it's hard. I will say, I think you need to take insurance costs into account these days. We bought something in West Palm Beach recently, and the insurance was, 20, 30% higher than we would have imagined for hurricane and flood. Those seem to be moving really quickly cost-wise. So I do think that that's a part of it. So, yeah, I mean, again, it depends on your time horizon, right? I mean, if you believe what some people prognosticate, some of these coastal markets could be in big trouble, really, in the next 50, 100 years. But I mean, weather, I don't know. I don't really take it into account when we look at markets or opportunities. Now, it's easy for me. We don't do anything on the West Coast, so wildfires might be a challenge, but we don't do anything west of Mississippi.
Brian, I think we've covered pretty much a good amount of what you and we can talk for days on how to establish deal flows and being best buddies with the best brokers in town, coming through on deals, not being a difficult buyer, et cetera, in order to get a deal flow. But in addition to that, obviously we can have multiple of these meetups and how to raise capital and kind of the deal flow. As far as the debt, what is your current assessment of what you're seeing in the market now from a debt perspective? Obviously, debt is cheap. We can look at it from a variety of ways. We can say, well, you should kind of try to secure as much debt as you can now. And as inflation continues to go up, banks seem relatively eager to lend money. But obviously you got to go through the stress test of every deal and not over leveraging the deals. But where do you see kind of debt or the debt market going in the next 6, 12, and 18 months? I mean, do you see a revision of this interest rates and that would eventually kind of start going up? And if so, how rapidly? And I don't know, just interested in general in your assessment on that part of it.
Yeah. I think to your point, it's a great time to lock in long-term debt. It's just so cheap. And again, when you look at your capital stack, it's a really cheap cost of capital. I know for us, CMBS world, we're getting sub 4%, 10 years fixed, 30-year amortization, sometimes 5 or 10 years interest only. This is free money, right? So, I would even take variable debt risk on right now. I really don't think rates are going to go anywhere anytime soon. If you look at the bond market, I can't see the 10-year moving at all, really. And even though the Fed said they're going to start tapering, I think the Delta variant has put that, in the backseat for a while now. I think we're in a persistently low interest rate environment. And I know there's a lot of fear about inflation. And that's even part of our pitch, right? I mean, because real estate's a great hedge against it.
Mm-hmm.
But given the advancement of technology and the fact that baby boomers are now leaving the workforce and they're not consuming, and everyone's job in Silicon Valley is to make everything cheaper and easier, I don't see where, other than healthcare, maybe private education, maybe housing, I can't see anywhere that inflation would happen anytime soon. So good time to put in debt.
Yeah, I agree. I don't think you mentioned before, but do you have you mentioned moving from various markets. Are you long-term holders, or are you guys cycling out like Raleigh's expensive, let's sell and go to, the next up and coming market?
Yeah, we're long-term hold. Most of our investors, unless it's going to be a pretty big multiple, because they don't really care about IRR. I don't think anyone knows what IRR is. Unless they're institutional, they're doing like a benchmark comp from one to the other. I don't think they care. Or they're a fund manager, they want their carry. Unless it's going to be a really big multiple. The problem is if I gave them the money back, they have nothing productive to do with it.
Mm-hmm.
So if I'm giving them a 10% coupon, they say let it play.
Yeah, it's better than their reinvestment rate they're going to get.
Yeah, and they're all worried about taxes. So yeah, we're long-term holders. We really think of ourselves as kind of a fixed income alternative for people.
Any other questions from anyone kind of in the chat at the moment?
No,
Brian, this has
somebody's out there
all
with a
been
question.
awesome, man. I mean, I think it's always encouraging to kind of hear folks who are in the same kind of in the same game and who are kind of looking to do the same thing. We are long-term holders ourselves. We, not fans of transactional costs that can eventually kill you. And like you mentioned, the risk of the fiscal risk of taxes that's looming, I think it's going to get a lot of guys kind of coming to the table on two things. One, either sell now, or two, just kind of hang on and mostly play the cash flow game and try to look for that kind of fixed income play, if you will.
Yeah, no, I appreciate you having me. I mean, I wish, what's really cool about what's happening now is people are doing meetups like this. People are creating content where there's really no barriers to entry, right? You can spend, if you have the time, you can learn about different asset classes, different investment theses, different strategies. It's all available to you for free. And you get people like me that have made a ton of mistakes. They can tell you, like, don't step in that pothole again. I stubbed my toe here. And it's really efficient, right? I don't have to have like 30 different conversations. I can all do it here. So I applaud you guys for putting these things on, because it is an incredible business. If you think about America has 13.5 million accredited investor households. Less than 3% have exposure to alternative assets. So like, this is a viable business for everybody on this call. But there's a right way to do it, Then there's like a bunch of wrong ways that I did initially.
Mhm.
So if I can ever help anybody, reach out. But I think this fractionalization of real asset ownership, this democratization of ownership of alternatives, it's just started. So I think it's an exciting time to get into the game.
Agreed.
Yeah, and we originally started our meetups because we wanted to network with other guys interested in multifamily, and then we started to do the educational component because it was exciting to see, other people move and progress in there, and every speaker we have had, you hear some good advice or learn some things you've said, really helpful. So it's became a benefit far beyond networking in there, and exciting to see people take their step. I think the comment you made about not worrying about, how big someone else is great, because, I think sometimes people get a little discouraged if they hear large numbers. But I know several guys who started out with a single family or a duplex and, get up to a couple thousand units, but it just takes time and work, and gets easier as you go along.
Great.
All right, I know there's got to be some
Well,
questions out there. Who's got some out there?
If there are no other questions, just want to thank you, Brian, for coming out tonight. Everyone, I just put my email and personal cell phone in the chat. So if you do have any other questions or need anything, you just send me an email or text, and make sure to get back to you. Question did just pop up.
Yeah, I can talk about that because the question was, do you see institutional and iBuyers disrupting residential? We do, because and that's what I was talking about. I think as we're going to get on with Brian, is that for a number of years I sold lots to home builders. The home builders sold homes primarily to owner occupants, families, and every once in a while they sold some to investors. And what we have now is institutional capital that's coming in, and it wants a piece of those homes, and it wants to use them as rentals. And to give you a comparison, and the institutional guys we were talking about before, the guys who have a lot of cash and need a very low return. So in multifamily, I think it's about a $3.5 trillion asset class in the United States, and the institutional investors own about 30 or 40% of that asset class. In single family, they're much smaller, like 3 to 4%, I think, right now, of rental properties, but they are coming in and they're going to get a large piece of it. And I think that's going to be a trend to look out for. They're going to have much more money than other investors. They're going to move faster, and they're going to have lower return requirements. So I definitely see that. I don't know. I think that was Team Brian. Elaine asked that question. I don't know what was driving it, but that's what we see here. We get multiple calls from guys in New York, Chicago, Los Angeles, Dallas. Hey, I need to buy. I had a guy from Atlanta call. He's like, I need to buy 1,500 rental homes in Florida in this year. We're doing a build to rent project. It's 200 units, and we're doing that in partnership with a home builder. The home builder started up its own build to rent division, as a lot of them are. And the gentleman I'm working with there, he's got to do 1,000 units this year. So where you used to have these home builders producing product that was going to be primarily owner occupied for sale, they're now all starting divisions that are going to be producing build for rent product. And a lot of that's going to go to institutional investors. It's not even going to go into the market for a home owner to even have a chance to bid on. So it's going to be interesting to see what that does to the price of, I guess what you could call fee simple single family homes, where you have just got married and you got a dog and you want to buy your own home, and there's going to be, I think, a limit on the supply, perhaps. So it could drive up the values of those existing single family homes in there. But everyone's kind of waiting to see how that's going to play out.
Yeah, I agree with you. I think given the amount of liquidity that the Fed is pumping into the system, given where valuations are in the stock market and where bonds are, all assets are going up in valuation across the board. It has to go somewhere.
Yeah, a lot of money trying to squeeze squeeze in into spots in a low yield world.
Well, if there's no more questions, again, thank you, Brian. In 2 weeks, we have Maurice Philogene talking about finding freedom through real estate, whether that's time freedom, financial freedom, geographic freedom. So I think it'd be very important thing to come out to. Sebastian's asking, when buying commercial properties, do you guys always provide proof of funds, LOI, BIO, and NDA initially?
What is POF?
Proof of funds.
No, 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 no. LOI with an NDA maybe. Yeah. Thank you guys for having me. It was really fun. You got my contact info. If I can ever be helpful, reach out.
Thank you very much, Brian. Great to have you.
Sean, Devin, you guys, I'll look you guys up. I'll probably be down in Orlando soon. So
Yeah.
thank you.
Hey, when you come down for that College Park thing, it's literally like a 3-minute drive from our office over here. So we'd love to come tour it with you, see what you're doing, just catch up. Sounds great.
Cool. Thanks,
All
guys.
right. Thanks, everyone.
Thanks, everyone.